Welcome, everyone. There's my slide with my picture on it. I apologize. That's actually what I look like, so I'm still not sure what my folks were thinking. But anyway, I am happy that you all have joined us on this presentation today to give us a chance to give you just a little insight on the things you need to be thinking about. And some of the stuff you probably are going to know. Hopefully there's something on here that you take away that is valuable to your company or to your organization. A little bit about myself. I've been with Avalara a little over 2 years. I spent much of my life working for a government or a bunch of governments. Started off working for the South Dakota legislature as their principal tax analyst, doing research and writing and drafting legislation. Then 10 years as the director of the South Dakota sales tax system. So I spent 10 years helping businesses understand what the laws of South Dakota required of them and all the things that were necessary. And then I went from that to the executive director of the Streamlined Sales Tax, which is an organization whose purpose is to make sales tax simpler and more uniform. It's kind of stalled a little bit, but it's mostly because of there's lots of reasons why it stalled, but in the beginning it was a really good organization. So let's talk a little bit about sales tax. This slide here gives you an idea of how important the sales tax is to state and local tax structures. It is a critical component to almost every state's sales tax, especially those that do not have an income tax. Tennessee, Florida, South Dakota, Texas, those states have, in some people's opinion, an over-reliance on sales tax, whereas our friends in Montana and Oregon and New Hampshire, they have an under-reliance on sales tax. But when you include both the general sales tax and the selective sales taxes, which can include motor vehicle excise taxes and the other things that are called an excise tax, but you often see on an invoice when you buy it, they can make up to 47% of total state revenue. Some states it's more, some states it's less. But what are some of the challenges of sales tax compliance? It's the law. It isn't something you get to avoid. There is some statute somewhere in some state that imposes an obligation on you that you would not take on yourself were it not for that law. Laws get enforced one way: audits. Audits are, in the best of times, intrusive. And that's about as good as one can say about an audit, is it's intrusive. They can be much worse than just intrusive. Sales tax management is manual. Too often it's manual. That is something that is changing, but it's changing because of the technology and the way that it is now possible to do things in a way that isn't completely manual. Labor intensive. We're all humans. We all make mistakes. We all misunderstand or we understand differently. It can be very expensive. Audits go wrong, then it can be very expensive. And rules change. There is 45 states in the District of Columbia with a sales tax of some sort. In addition, there are several other little tiny sales taxes in there somewhere. And there are any number of ways that things can be different, and they're always being changed. And this is the time of the year when state legislators meet, so this is the time of the year when new things are being changed. And no one makes any money managing their sales tax. As good as you are and good as you can be, the best you can do is save money, but really hard to make money. So, a Wakefield research study published in July 2013 asking businesses about their sales tax compliance. 44% couldn't remember the last time they updated their sales tax processes, which may be the right answer. You might be in a business where you don't need to update your sales tax process. 48%, unfortunately, felt that if they were to be audited, the auditor would likely find a mistake. 48% is a pretty high number. Maybe it's a very insignificant mistake. Maybe it's not. On average, those who were audited, the total cost to manage that sales tax audit was $114,000. The Aberdeen Group published a study in January of this year that talked about the different way where they'd asked businesses, what do you spend your time doing when it comes to sales tax administration? And the average was 302 hours annually lost to manual workload. You know, from administration of taxability changes, tax return preparation and filing, responded to audit requests to manage the audit process, and all the way down to managing use tax requirements. All those things are a requirement under a state sales tax law, and they're all things that one way or the other, someone is required to do. So what's new? One of the things that's changing these days is that, oops, what happened there? Is that states are restless. They do not want to rely on the rules as they have been handed down by the United States Supreme Court. I think you should talk to your accountant or your attorney to see whether or not you can continue to rely on Quill versus North Dakota. With all the states now that have adopted click-through nexus rules and the affiliate nexus rules, it's a dangerous place to be if you market through those types of activities. And states are continuing to find ways of trying to breach that Quill versus North Dakota. In the budget that the governor of New York promulgated last month, they included legislation that will require operators of third-party markets to collect sales tax on every sale going into New York by anybody who sells on that third-party market, regardless of whether or not the seller who's on that third-party market has physical presence of any form inside of New York. If that legislation passes, there are going to be a lot more people, and they're successful, and that's still debatable. There are going to be a lot more people who are having their sales taxed in New York than there are today, and if New York is successful, you can count on every state going down that path. Nexus creating activities. Do you know where your sales force is today? Do you have independent agents that sell for you? Are some of those independent agents in non-traditional agents, as in the Boy Scouts of Buffalo, New York, who have a link to your website on their website, and they encourage people to click on your link and make a purchase? How many trade shows does your sales folks attend every year? Do you know where they are? Do you keep track of them? Do you have a spreadsheet that shows you, in addition to where your salespeople are located and in where your salespeople are traveling, do you have one that includes where they attend trade shows? And do you have that matched up with the list of states that say it's okay to attend a trade show and that doesn't create physical presence, versus the ones who say, if you step into our state for any reason whatsoever, you've got Nexus. And that Nexus will last for a year or 2 years or 3 years. Amazon laws, I talked about those already. The New York highest appellate court approved that. The U.S. Supreme Court did not take the case. Don't know if that means anything. They like to have good facts before they make good law. As you all know, bad facts make really bad law, and the Supreme Court is pretty careful about the facts that they take up. But this is where you need to talk to your attorney or your accountant, because if you are one of those folks that are in the business of marketing through other people's websites, you need to have a really great degree of comfort in whether or not that is going to require you to collect. And there's 14 states that have passed these laws, and I presume there'll be more. And I think that's the general approach that I take is I'm going to always presume that states will always try to come up with something new in the way of physical presence or nexus. Sometimes they won't even bother with physical presence. It'll just be nexus, and you'll have to fight it. accounting professionals say that 70% of their companies conduct sales online, yet 47% remit or file only to one state. That is a disconnect. That's the disconnect that the states are trying to solve right there. They want to get those two numbers to be exactly the same. You make sales, if 70% of businesses sell everywhere, states want 70% of businesses to file everywhere. So, what makes this really complicated is that you now have a new set of states that you have to worry about, and you have to worry about the rules and the rates that vary between them. Rates, frankly, are relatively simple. You can put rates into a computer very simply. Match them up with a 9-digit zip code, then you have a pretty good chance of being right most of the time. Rules are an entirely different thing. States differ significantly in how they define and treat those defined terms for any number of different products and services. For example, software and hardware. Well, hardware is relatively straightforward. Software isn't straightforward. What if you get your software online? What if you don't use what if that software is never downloaded on any of the equipment that you have? All you have is dumb terminals. And we're going back 25 years in computing, where in the beginning we had a dumb terminal that was connected to a mainframe computer somewhere, and the mainframe, all the software was on the mainframe computer, and all your stuff on your desk did was interact with that mainframe computer. We are going to those days now with cloud services. Software in the cloud, states are confused as heck about what software in the cloud is, and they have multiple rules and multiple ways of dealing with the different ways that software can be accessed in the cloud. Digital good. Streaming video versus one-time listen versus audio versus whatever. States don't understand digital goods, mostly because their laws are relatively static and the industry isn't static. Tomorrow someone will invent something new and find 500,000 customers to start buying it, and most of the states will look at their law and say, well, my law doesn't say anything about this, and yet they still have to have an answer. Services. Is your thing a service in every state? Is it a service in most states? Is it a service in no states? Does the distinction between how you sell it impact whether or not it's taxable in states A versus state B? Medical devices and equipment. 3 relatively broad definitions of medical equipment out there. You have durable medical equipment, you have prosthetic devices. States generally exempt those things. They don't always exempt those things. They don't always exempt. Sometimes they make that exemption exceptionally complicated. It's an exemption. It's an exempt product if it is reimbursable by Medicare, or if it is actually reimbursed by Medicare, or if it is prescribed by a healthcare professional, or if it's purchased by a for-profit nursing home versus a non-profit nursing home. Lots of different ways the states treat medical devices and equipment. Food and beverages. 6 different ways of defining a soft drink. Is it a percentage of the sugar that's in the, or not sugar, excuse me, a percentage of the juice, vegetable or fruit juice in it? Is it a function of carbonation? Food, prepared food, non-prepared food. The same exact bag of potato chips can be exempt when purchased in a grocery store if the state exempts groceries, but taxable in the fast food restaurant right across the street. Same exact bag of potato chips. One, it's groceries. The other, it's prepared food. And what about the states where the definition isn't groceries? It's food that it's consumed off premises. What does consumed off premises mean? And do those states that have the different definition, that have the same exact definition of consumed off premises, actually agree with each other on what off premises means? Clothing and apparel, generally simpler than most areas. Most states tax it. A few states exempt it. Not all the states that exempt it use the same definition. And then you have these states that have these these thresholds where clothing is exempt if it is an item that's cost less than $50 or costs less than $110, or it's the first $110 is taxable and everything over the $110, or excuse me, the first $110 is exempt and everything over the $110 is taxable. So while clothing is relatively simple compared to some of these other things, in some states it's very, very complicated. School-related products. If you sell into a state that has a school supply holiday, there's a reasonable chance that it's the same definition in its neighboring state, but you can't guarantee that, which means you have to go through the Department of Revenue's website and find their publication on the things that are included in school holidays to make sure that it's the same in the other states you sell in. Otherwise, you have to have your computer program to do it differently. Dietary supplements versus nutritional supplements. Is the tax that you need to charge determined by whether or not it has a label from some federal regulatory agency? And do those labels mean the same thing in every state? And that's just the beginning. I don't even want to get into agricultural equipment and agricultural supplies. That is a whole seminar all by itself. Services are taxable, but not always. Every state with a sales tax taxes some services. A very few states, half a dozen, tax a lot of services. What they don't know is how to define what is and what isn't a service. You need to know the difference between tangible personal property, real property services, professional services, business services, personal services. There's a long list of services that are provided in this country that you either sell yourself or you are a consumer of that are treated entirely differently from each other, state to state to state. Professional services, for example. There are 4 states that tax, no, that's not true. There's 3 states that tax professional services broadly. Hawaii, New Mexico, and South Dakota tax lawyers and architects and engineers and accountants. West Virginia, which is another state that taxes a lot of services, exempts professional services. But when you read their definition of professional services, it is so vague that you can be caught not collecting sales tax, or vice versa, collecting sales tax when you shouldn't, because it's really hard to tell from their definition of what a professional service is, or what a professional is, because they don't define professional services, they define professionals. Be very careful in services. Product taxability is always changing. We have our nice Hershey bar. This particular one is taxable because it's candy. It's candy. Hershey bar, I think everybody would agree that a Hershey bar is candy, unless you buy one of those really big ones and you're going to chop it up and put it into, chocolate cake, then you might have a different opinion. But in many states, the taxability of a Hershey bar is a function of what its ingredients are, and if it has flour, it is a grocery item and it's exempt. If it doesn't, it's candy and it's taxable. 2 examples of a Hershey bar, one has flour, one doesn't have flour. Soft drinks. Non-carbonated with supplement label is taxable in some states. Non-carbonated with nutritional label is exempt. Now, in theory, you can look at the bottle itself or the container and say, okay, I know I'm in a state that taxes carbonated stuff unless it has a nutritional supplement on. If you know that, you can look at the product and say, okay, this is non-carbonated and it has a nutritional supplement. So I know what the taxability is. Tax rates. In the old days, businesses were really in a difficult position because they either had to hard code every one of their customers into their system to say, okay, I know that Scott Peterson lives in Nashville, Tennessee, and I know Nashville, Tennessee has a sales tax, and I know the sales tax rate is 9.25%. You can build a system, and this is what happens in the utility area. So if you operate a natural gas company or you operate a telephone company, you would have a hard-coded system where each individual was an account, and that account came with a sales tax rate and with an exemption flag. So you knew that the United Church of Christ on this corner was exempt because your state exempted churches from sales tax and utility services. That isn't a particularly scalable way of doing business, and certainly isn't on the internet. It's very difficult to have a hard-coded system. And so when states started allowing every local government in the world to have sales taxes, those who had to sell remotely, or those who sold remotely, were in a very difficult position. They couldn't hard code a sales tax rate for a customer because they may not have a customer in the sense of a utility does. So they defaulted to zip codes. And in the early days, a 5-digit zip code is all we had. And in most places, a 5-digit zip code is going to be wrong often, because the city, county, and special purpose districts do not follow zip code lines. With the invention of 9-digit zip codes, things got a little bit more accurate, but still not accurate enough. You can have tax rates that vary within the same zip code. They're very blunt. 5-digit is a horrible thing to use. You can't even use a 5-digit zip code and be right 100% of the time in states that don't have a local sales taxes. There, states like Kentucky and New Jersey and Michigan that don't have local sales taxes have addresses that are not inside their state. There are people who live in Kentucky who have Tennessee addresses, and vice versa. There are people who live in Tennessee that have Kentucky addresses, and with the same zip code, because zip codes aren't a function of governmental boundaries. They're a function of delivering the mail. An example, one that we like to talk about because it's really kind of entertaining, is the little village of Greenwood in Colorado. One zip code, 4 different sales tax rates. If you get a chance, go to Avalara.com and look at our map and look for Greenwood Village, Colorado. It's an interesting shaped little community. Collecting exemption certificates. One more area where the risk is just black and white. You make a sale to someone, you do not charge them sales tax, and you do not have a way of proving that was an exempt sale, you will pay the sales tax when you're audited. This is easy money for states. It's frustrating money for those who believe that sales tax should be, open and honest, and everybody should be playing by somewhat fair rules. But it's easy money for states. Don't charge sales tax, can't prove why, you pay the tax. Now maybe you can get that back from your customer, maybe you can't. You need to know why and when your customers are exempt, or why and when the products that you sell are exempt. 3 primary exemptions, product-based. Clothing in Minnesota. Minnesota does not tax clothing. Clothing is an exempt product. You do not have to have an exemption certificate when you sell clothing to someone in Minnesota, and you do not charge them sales tax. No exemption certificate required. Entity-based. Entity is a thing, a person. It could be a person. It could be, most likely, in most cases, it's an organization. The Red Cross is an entity. The Red Cross is exempt from sales tax in every state. You cannot make a sale in any state, you cannot make a sale to the Red Cross without proof in your records that it was the Red Cross that made that purchase. You have to have something, an exemption certificate, that they have given to you, the Red Cross has given to you, the seller, that proves that they told you they are the Red Cross and that they are exempt from sales tax because state law exempts the Red Cross as an entity. Some states will want proof of payment. Not only must you have that exemption certificate that says they are the Red Cross, There must be some way of tying the actual payment itself to the Red Cross. A check made out from the Red Cross, or a credit card issued in the name of the Red Cross. The third type of exemption are use-based exemptions. Use-based exemptions are for those products that the taxability changes based on how it's used. John Deere tractors. And in these cases, you have to have an exemption certificate to prove the use of that product. John Deere tractors are a piece of agricultural equipment, and in many states they are exempt when purchased by someone who's going to use it for agricultural purposes. The agricultural purpose is the use that creates the exemption. The same exact John Deere tractor is taxable when purchased by someone who's not going to use it for agricultural purposes. So you can have two John Deere tractors side by side on either side of a barbed wire fence out in the middle of South Dakota. And the one that's on the agricultural land purchased by the rancher for agricultural purposes will be exempt from sales tax. And the one on the other side of the barbed wire fence purchased by the local construction company to rebuild the road in front of the rancher's house, that one is taxable because it's not being used for agricultural purposes. Now, please don't use South Dakota as an example because South Dakota taxes agricultural equipment. But that's exactly the kind of thing that you get with use-based exemptions. Another area where you need to be very careful is on the remittance process. States all want you to remit your taxes electronically, and they want you to file electronically. And yet they haven't got there yet. Or they all have a form of a mandate, and they're all trying to get to a mandate, and someday they will all get to a mandate. And that mandate will be for all sellers of all types, but they're not there yet. And so you need to be very careful in knowing which state requires what of you. They're all different. Everybody's sales tax form is different. Most remittances are relatively, they're common. But even electronic funds transfer, ACH credit isn't always ACH credit. You don't always get the same information back from the state when you've made your payment. Sometimes you know that it was you that they've given you a record that shows it was you that made the remittance and the amount of the remittance. But some states, all they do is say, thank you. And that's what you get. Your record says, yep. And you need to wonder then, which of my four entities that I file for in this state am I just getting a yep for? This is one of those things that auditors add to their list of things that generate questions. If you can't file a return on time, and if you can't make a remittance on time, well, else aren't you getting right? And when auditors are building their file for whom they're going to audit, they build in lots of little things that create potential for examination. Auditing has become quite scientific. It has become somewhat scientific, and it has become somewhat automated. So many states today have a computer system which has a dozen or so different audit selection factors in it. And the computer's out there all the time looking at you and looking at how you conduct business and comparing you with others like yourself and doing little check marks. And so here, this person is exactly like everybody else in the industry in our location, and everybody else is fine, so you must be fine. Or you're not like everybody else in your industry, and everybody else is fine, but you're not like everybody else, so you must not be fine. Bill to, ship to, sourcing. Sourcing should be relatively simple. If all the things the state should get right, they should get this right, but they don't. The one thing that you can count on is when you are delivering products on an interstate basis, every state uses destination sourcing for interstate sales of products. So if you are shipping shoes from Minneapolis to Oklahoma City, and the shipper, the retailer, has physical presence in both Minneapolis and Oklahoma City, the retailer should collect the Oklahoma City sales tax on those shoes, and not because they're taxable in Oklahoma City, even though they're exempt in Minneapolis, and vice versa. Same exact retailer shipping the shoes from Oklahoma to Minneapolis. They're taxable in Oklahoma. They're exempt in Minneapolis. That Oklahoma retailer is expected to know not to collect sales tax on those shoes when they're shipped to Minneapolis. Now, it gets a little more complicated when that retailer who has physical presence in Minneapolis and Oklahoma City and Austin and Dallas, because when they ship shoes from Austin to Dallas, which are taxable, they collect the Austin City sales tax because Texas is an origin destination, or an origin sourcing state for intrastate transactions. So you need to have your computer programmed or your staff programmed to know that when you're shipping shoes from Austin to Dallas, you collect the Austin City sales tax. When you're shipping shoes from Oklahoma City to Dallas, you collect the Dallas sales tax because that's an interstate shipment. And Texas, like everybody else, uses destination sourcing for interstate sales. Not every state that does origin sourcing uses the same rules. Those states don't always say when origin is required and when it isn't. And in California, of all places, they do it both ways. The county sales tax is destination, the city sales taxes are origin. So if you're trying to manage California sales tax, you have to be able to do it both ways inside the same state. Use tax. If you follow what's going on in Congress and what the states are trying to get done through Congress or through the Supreme Court, you know what use tax is. Use tax is that tax that doesn't get collected when you purchase something from somebody that does not have a physical presence in a state and isn't legally required to collect the sales tax. Well, it's a lot of money, and this is what states have been after for a very long time, and they are very serious about getting that use tax collected. Sales tax is tax that's collected by the seller from a retail sale. Use tax is the tax that's paid by, in this situation, now we'll talk about seller's use tax here in a second. Use tax in this situation is the tax paid by you as the consumer. You purchase something from somebody out of state, and they didn't charge you sales tax. They didn't charge you seller's use tax, but you use it in that state, and that state taxes the use of that product in your state. You file a sales tax return in any state in this country, and you do not show any use tax on that return, that gets added to the list of things that that state's audit selection computer uses to determine who gets audited. If they look at your industry and they say 95% of the businesses in that industry report some use tax every month or every year, and you don't, that's a flag. You become someone who's going to rise up on the list of potential auditees. And use tax should be relatively simple. If you were to buy something inside your state and it was taxable to you, if the seller would have to collect sales tax from you, well, then it's subject to use tax as well. Although there are differences. Then go to Missouri. Many local governments in Missouri do not have a use tax. So the sales tax rate and the use tax rate in Missouri are not the same thing for local purposes. So if you do business in Missouri, pay very careful attention to use tax. The difference in this situation is that sales tax is an activity imposed on the seller, and use tax is an activity imposed on the buyer. Remember, this conversation is about what gets you in trouble with the state. Sales tax rules that will mess you up inside of a state. Sales tax holidays. It is and I didn't know this until a few years ago, that this is a relatively southern and southeastern phenomenon. Many states have sales tax holidays, and the holidays apply to clothing, they apply to school supplies, firearms. Louisiana and I think one other state have a sales tax holiday each year on firearms and equipment and ammunition. What's important about these things is that they are limited in time and they are limited in scope. Each of them has a set list of things that they exempt for a set period of time. So you are someone who sells school supplies, and the state has a school supply holiday, and your sales don't change, and your sales tax remittance don't change. The first thing the state's going to think is they did not participate in the sales tax holidays, and if they can't get that right, what else aren't they getting right? These things are, in some of these states, as you see on this map, there's a uniform definition of what goes into some of these holidays, but not all the states on this map use the same definitions for the different things that they exempt. And you need to be able to manage these things. So if you're selling all over the country and you're selling things that are at some point in time in a year subject to a sales tax holiday, you need to be very careful. Audit trails. I've been talking about what gets you audited and what things you need to remember when you are trying to avoid being audited. Fail and file a return. You don't do that, they wonder what else you can't do. Failing to report sales. They will compare your sales to what you put on your income tax return. So if you are in a state that has a corporate income tax or personal income tax, if you're someone who has a personal income tax and you report your sales to the IRS through your personal income tax, the state gets that information, and they will compare your sales tax returns with the sales that you reported on your income tax return, and if they're not the same, they're going to ask you why they're not the same. Take excessive credits or exclusions on a return. You're in the business of selling clothes in the middle of a state that taxes clothes, and 90% of your sales are exempt. They are going to wonder why. Now, maybe you only sell things to school districts, so 90% of your customers are school districts, and they're going to be exempt. But they will ask you why. Filing returns of errors. If your return doesn't balance, they assume you're doing other things wrong, and they will need to come in, and it'll be an educational opportunity for you when they came in and help you figure out how to make sure that you're not making math errors on your returns. Return information that doesn't match other records. Many states have gone to data warehouses where they have these enormous pools of data that they have purchased that they can use to compare you to people that are like you. Now, they'll look, in a perfect world, they'll compare you to your competitors inside your own market, but they don't have to do that. They can compare you with anybody, anywhere, and make sure that what you do is similar to what other people do. And the way it helps states in a couple different ways. One, they can pick and choose inside an industry who they audit. So if they have an entire industry and everybody's exactly the same or within slight percentages of being the same, they can audit one or two people in the entire industry and feel relatively comfortable that they understand the entire industry. So that's one way that those data warehouses help states. And it may help you. On the other hand, if you're different from everybody else, that's also how it helps the states. They know, oh, okay, John's store is much different than Jane's store, and Jane's store is like everybody else. John must be doing something wrong. Let's talk to John. And then mistakes on previous audits. If the mistakes are really bad, if you just didn't understand something, it's not unusual for a state to come back and say, I know that last audit didn't go so well for you, but I think we need to come in and talk to you again to make sure that that the things that weren't right the first time aren't being repeated. This is where you'll see. So if the reason you got audited is because your exempt sales are radically different than everybody else in your industry, you get audited and you've made a mistake, but your returns don't change, your returns continue to have exempt sales that are radically different than everybody else, they're going to come back in and audit you. Or if they audit you and they find that you didn't report any use tax and they make an assessment on you, and then 3 years later you're still not reporting use tax, you can rest assured they're going to come in and audit you. And then exemption certificates. We could do a whole seminar on exemption certificates. And it isn't always misused. It's just sometimes it's just not enough care given to the maintenance of exemption certificates. Some states, Florida and Washington, the exemption certificates expire. So if you aren't managing those things every year, you're going to be audited, and they're going to find you with exemption certificates that have expired. Now, they'll give you an X amount of time to get new ones. But if you can't get those done in that period of time, let's say the person that you made the sales to is gone out of business, they've died, and you can't get good information from them, that's too bad. And one of the issues that folks often find themselves caught in is they made a legitimate exempt sale to someone. They knew that that person was exempt. They don't have the certificate to prove it, and they're out of business, and you can't find them. It's not the state's fault. It becomes your fault, and that's when you make a payment to the state. And then use tax. I've hit the use tax things hard today. Okay, how do you reduce your audit risk? Do a nexus study. Know where your salespeople are. Know where your salespeople attend trade shows. Stay up to date with rates, rules, and boundary changes. Rates change fairly often. Rules change sometimes. I mean, legislators change the rules. Sometimes the agencies will change the rules. Boundaries change all the darn time. It's amazing how many especially cities, how many city boundaries and city annexations go on out there. People are being annexed inside their city every day in this country. It's very complicated. If you're buying things from people that aren't charging you sales tax and it's taxable, report the use tax. This is the kind of thing that states expect to see on business returns. Be compliant from day one. There's nothing that makes a state auditor feel better than a new business calling them up and saying, hey, I'm about to open up a store in your state, and I just really would like a couple minutes of your time. Can you help me understand what I need to know? And is there a way we can chat about, all the things that are responsible that I need to do? States like that. They keep records. They create a file on you, and in that file will be a summary of that conversation. That's a good thing for you. Automate. You all know that you're automating everything. You automate your payroll. You automate everything. This is an area you should automate as well. Make sure you have an understanding of your filing requirements. Is your return due on the 20th, the 23rd, or the 30th? Are you a monthly, a quarterly, a semi-annual, or an annual filer? Are you a large filer and you have to file your return on the 20th day of the month electronically, but because you're so large, you have to pay twice a month, and there's a half a dozen or more states that make people pay twice a month? Are you looking at your customers from the top and not from the street? I told you 5-digit zip codes are often wrong. 9-digit zip codes are occasionally wrong. The best way to do this is latitude and longitude. Product taxability. Do you know which states tax or exempt what you sell? Do you have records that prove your sales? And obviously exemption certificates. They're just critical. A little bit about us. This is the business we're in. Avalara Avatax, address validation, sourcing rules, jurisdiction assignment, sourcing, product taxability and reporting, cert capture, exemption management beyond anyone's expectations. This product is so good that it's the country's number one. It's amazing. And it never returns. There's no point in being in the return business anymore. There are folks that are happy to do that for you, and we are one of them. So that is it. I spoke very quickly.